This episode is brought to you by Newline by Fifth Third. Drive your fintech forward with the embedded finance platform designed for enterprise fintech and backed by a leading financial institution. Discover how Newline can transform your business at newline53.com. The Fintech Takes podcast is also brought to you by Paddle. Need more revenue, more growth, and more time? Over 5,000 digital businesses trust Paddle as their merchant of record, or MOR. Unlock more revenue, more growth, and more time. Get more at paddle.com. Okay, we have a great episode for you today. This is the April edition of Fintech Recap with my friend and the publisher of Fintech Business Weekly, Jason Mikula. Jason stops by to take us on another 3-hour tour of Bass Island because some very exciting and dramatic things happened. We also, as everyone in the fintech ecosystem is doing right now, chatted about Klarna, which has filed the paperwork to go public. We talked about what was in their F1, not S1, F1 filing, what that means, how it's going to impact competition in the BNPL space with a firm who obviously is already public. So we really got into a lot of BNPL detail. And then at the very end, it wouldn't be a good episode of Fintech Recap if either Jason or I didn't rant a little bit. In this case, I was the one who went off the deep end. There's a new neobank for gamblers out there that made me absolutely lose my mind. If you're listening to it with polite company, please ask them to do earmuffs when you get to that section of the podcast, because I do come a little unhinged, but I think it was worth it, and it definitely made for an entertaining episode. Before we get to the podcast, I also want to quickly mention this week we are actually opening up access to a new product that we built at Fintech Takes called the Fintech Takes Network. And the network is really just a new type of professional networking platform specifically built for fintech professionals. So if you kind of feel like Twitter is losing its mind, or if you think that LinkedIn is just overrun with cold calls and outbound salespeople, but you're looking for the sort of camaraderie and insights and ideas and generosity that you're used to getting from the fintech ecosystem, I would recommend trying the Fintech Takes Network. It's new, but so far it's been working really well. And if you're interested in getting access to it and applying to be a member, please watch for links and announcements about the Fintech Takes Network in the Fintech Takes newsletter. And I'll also be talking a lot more about it in future episodes of the podcast. So with that, I'm going to go ahead and drop us right into Fintech Recap. Hello, and welcome back to Fintech Recap. It is a new month, almost, when we're recording it. It will be by the time you listen to it. So we are back talking about what's been happening over the last month or so in fintech. My name is Alex Johnson, and I am joined, as always, by, back in his native, except not native land, but his home away from home, Jason Mikula, publisher of Fintech Business Weekly. Jason, it's great to see you via Riverside. We were just together in Vegas not that long ago.
Yeah, I feel like I barely saw you, because when we do panels together, it's not like we're talking, but we're not talking.
No, not like talking. We're doing whatever this is. Yeah, exactly.
And speaking of my not native adopted homeland, I actually have an appointment to give all of my biometric information to the Dutch Immigration Authority tomorrow morning to renew my visa so that I can stay here.
Go ahead and make the joke I know you wanted to make. I might need to give my biometric information to the government of the Netherlands.
I tweeted this. I don't know if you saw it. The visa I'm on at the moment is actually called DAFT, which is the Dutch-American Friendship Treaty. And so the joke is, I'm not sure how much longer that friendship treaty is going to be around.
Also, the acronym being DAFT is just that rules.
Yes,
that is so great. Yeah. I love that. That's more like, I guess, British English than American English, but still, I can appreciate the joke. Well, it is great to see you again. I know you've been doing a tremendous amount of travel all around the place, including Vegas, but obviously other stops as well. I, too, have been on the road, although this week I've been at home all week, which is a little unusual in the springtime season. So anyway, we should do a little podcast, and some stuff has happened, including
There's been
Jason.
news.
Yeah, like a couple of things I feel like you and I and everyone else in the fintech ecosystem has all been talking and writing about. So we might as well do a little podcasting. Are you ready to go?
Let's do it.
All right, so we're going to talk Klarna because everyone is required by fintech constitutional amendment to talk about any fintech company that goes public. And as listeners, I'm sure know, Klarna has filed the paperwork to go public, which we've been expecting for a while. As Jason very astutely pointed out to me, because I was way too tired to notice such an obvious thing, the form that Klarna as a foreign entity filed is called an F1, not an S1, as I incorrectly stated in my newsletter talking about the Klarna news. So, Jason, thank you for that small correction. But maybe we can spend a little time talking about all of the different Klarna-y things that have been happening, a lot of which has been sort of news timed around the filing of this paperwork, and then get into the actual numbers from the F1. Does that work?
That works.
Okay, so I will quickly recap a couple of things that have been sort of big news stories right around the same time that they filed this paperwork. The first one is the exclusive deal that they have with Walmart. I put exclusive in air quotes, not that anyone can see that, but this got a lot of coverage right around the same time that Klarna filed to go public. Clearly, it was timed at that same time in order to make a big splash. And it did indeed make a big splash. It was presented by many mainstream media publications as Klarna essentially stealing away the buy now, pay later exclusive relationship that Affirm had with Walmart. This is not really true the way it was presented in a lot of those mainstream media publications. For anyone who knows Walmart and their sort of dealings with fintech and financial services companies, one thing that you know is that Walmart never really has exclusives for all of a thing with anyone. That's just not, they're big enough that they don't have to play that game, and they typically don't. And by the way, when they do, they're also not always the nicest partner to deal with in those respects. You can talk to Capital One about that if you want. So in general, not an exclusive for everything Walmart. It is, in fact, much more narrowly focused on OnePay, which is the fintech company that is co-owned by Walmart and Ribbit Capital. OnePay has signed a deal in the US for Klarna to be the provider of installment loans between 3 and 36 months with interest rates ranging from 10% to 36%. Now, Jason, a couple of interesting things about this deal. One thing that I noticed is that OnePay is actually going to handle all of the customer-facing interactions and sort of customer-level user interface around this. And so literally, Klarna is just going to be plugged in on the back end as the originating lender and I guess, funding mechanism for these loans, these installment loans. But all of the sort of customer-facing experience, that's all going to be branded OnePay. It's going to look like OnePay. OnePay is going to handle all of the servicing of the loans. This is very unusual relative to most buy now, pay later arrangements where the buy now, pay later provider is embedded into the retailer or merchant's point of sale environments, whether that's in person or online. But they're branded themselves. They sort of take ownership over the lending portion of that relationship. They do all of the servicing of the loans. And one of the reasons that's significant is that that's actually a source for a lot of organic, quote unquote, growth for getting customers. Because then once you get one loan from Klarna through some merchant website, then you're a Klarna customer, you download the Klarna app, and then Klarna has a whole bunch of other ways that they try to monetize the attention that they've gotten from the merchant. That's not going to happen from what I can tell with this OnePay deal. So I think that's notable. Also notable is the fact that this is not what Klarna does. And you pointed this out in your piece that you wrote about all things Klarna in your newsletter. Mostly the volume that they process is either pay in full transactions, meaning essentially just facilitating full payments at the point of sale, or pay in four, which is what they're most well known for and what most of their volume goes through. From what I can tell, Jason, only about 5% of Klarna's volume is these installment loans with interest. So this is not something that they do much. And the two things about that that are interesting to me are, one, there is actually a portion of Klarna's revenue, which actually has been growing quite a bit, which is related to what they call reminder fees and snooze fees, which we'll talk a little bit more about. But these are fees associated with either not paying on time or needing to move or adjust your payment date for certain types of lending products that they offer. That is a growing portion of Klarna's revenue. I would be a little surprised if Walmart was just cool allowing those types of fees exactly the way that Walmart has traditionally structured them. So it didn't say anything about this in the press release, but I think that might be an area where there might be some differences from the way Klarna typically does it. And then the other part that I know you'll find interesting, this might just be a topic for you and I and no one else cares, but I can tell you that public market investors who cover Pagaya, which is a embedded second look lending network that I am personally obsessed with. Pagaya has a partnership with Klarna. And the news of this partnership with Walmart, or I should say OnePay and Klarna, definitely caught the interest of those stock market analysts that cover Pagaya. And I think there's an expectation on their part that Klarna is actually going to be the sort of behind the scenes originator and funder of a lot of the lending volume that's now going to go through this OnePay Klarna relationship. I have no idea if Walmart and OnePay are aware of that, comfortable with that, what they think about that. But I think that's the other element to this sort of arrangement, specifically because it's these installment loans that Klarna doesn't do a lot of, that I find interesting. And then final thing, and then I want to get your take on this Walmart stuff. There was a little footnote that some people noted, including yourself, in the Klarna IPO filing that stated that Klarna has entered into a commercial agreement with a global partner pursuant to which Klarna granted 15 million warrants, roughly, each to acquire one ordinary share in Klarna Group PLC in exchange for certain services with a weighted average exercise price of $34 per warrant. So essentially, the option to buy shares in the soon-to-be public Klarna. The partner is unnamed, but I've heard some informed speculation from a number of sources that that partner is in fact Walmart, which would suggest that to a degree, OnePay and Walmart are being given a monetary gift as a part of this arrangement or this partnership that Klarna has acquired. So, Jason, I'm going to pause there. That was a lot. What jumps out to you?
Yeah, I mean, so Affirm being the most, in my opinion, like logical public market comp in the United States, has been the logical point to sort of like draw some comparisons. I mean, as you pointed out, the makeup of Klarna's business, is quite different than Affirm's, and we can talk about some of the sort of underlying origin story about why. But as I was pulling the data, and I should have just asked Jevs because he already had it all.
That's what I did. I cheated.
But I sat there and schlepped my way through the Affirm's old S1, their FY 2024, which I think you and I texted about how we hate fiscal years.
It's horrible.
And Klarna's F1, it's like, like 80%, 79% of Klarna's business is pay in 4 and also pay in 30, which in my head, I just sort of think of those as the same thing. Like either it is 4 payments over like a 6-week period, or you're just deferring the payment for 30 days. So like slightly different, but like functionally the same, similar risk profile. And only 5% of its 2024 volume was interest-bearing installment loans. So, it's like, okay, you drove some good press coverage by saying, having a very carefully worded press release that's apparently led most mainstream press to cover this as Klarna poaches BNPL relationship for Walmart from Affirm, which is just factually inaccurate. Affirm put out an 8K, I think the same day, saying like, as of the filing of this 8K, we are still working with Walmart. Could that change? Yes. To your point, and I've written about Walmart financial services business previously, mostly in the context of what eventually became known as One. For a while, it had no name. And then for a while it was like Hazel, if anyone remembers that except for me, before it became One with the acquisition of One. But if you go to Walmart's website today, they still offer the Walmart Money Card, which is basically a white label green dot, and they still offer Green Dot's card. And so, to your point, it's quite clear that historically Walmart has not done exclusive arrangements in its financial services business. I mean, what turned into One started over 4 years ago, and Walmart still offers these two Green Dot products, and rinse and repeat in the remittance space, where they have a Walmart like white labeled thing called Walmart to Walmart, which I always forget. I think that's RIA. And they also work with MoneyGram and Western Union. So they just don't have a history of doing exclusive deals because they just really don't need to, given their scale. I can't help but like be a little bit cynical, and whenever we're talking, it's like the less filtered version of me versus the newsletter.
That's why we love you.
Klarna raised at a peak valuation of, it was like 45 billion and change.
SoftBank, yeah.
And so, who knows what the structuring and the preference stack and all of that in that deal was, but like if you're Klarna CEO Sebastian Semitowski, like you have every incentive to try to drum up as much demand, both for the actual IPO, so when your bankers are doing the roadshow and selling to institutional investors primarily, as well as to generate that first day pop, which, by the way, I hate, and it like statistically is meaningless because for a whole lot of reasons, but we don't need to get into that. He has every incentive and motivation to go do that. And so you have this kind of misleading Walmart exclusive. I think even more transparent was the tweet he sent in early Feb that Klarna was going to, quote, embrace crypto, more to come, end quote, with no explanation of how, why, or in what capacity. I, did a quick Command F on the IPO filing. Like, it didn't mention crypto a single time.
Right, because they don't do any.
Yeah. And then, of course, the long-running AI narrative of like, we're just going to fire everyone and replace them with AI, but then like backpedaling somewhat to say like, oh, actually, human customer support's important, and we're going to emphasize it.
Right.
I've been on this ride too many times not to see all this and like read it as you're trying to pump the IPO price. Like, I get it. That's kind of your job, I guess. But if you look at the sort of messaging comms strategy of like Max Levchin and Affirm, it couldn't be more different.
Yeah, no, I totally agree with that. And I think that, just to emphasize a couple of things you said, I mean, Affirm and Klarna are just wildly different businesses, right? I mean, they just are, even though they're very natural points of comparison to each other. As you said, one is very focused almost entirely on installment lending and does a little bit of pay by four and all those kind of things, but for the most part it's like installment lending. That's Affirm. The other one does almost entirely pay in 4, pay in 30, pay now, and that's Klarna. And so when you see them kind of occasionally overlap a little bit, there's actually an interview that Max Levchin did that sort of in response to the Walmart news and trying to sort of calm the market down a little bit, which I actually thought he made a good point in, which was, think of Klarna as trying to replace your debit card and think of Affirm as trying to replace your credit card. And I thought that was a fairly sort of easy way of kind of dividing up the two, because he's right? I mean, like credit card, revolving interest, lending on credit cards, like that is clearly what Affirm is aiming at. That's what the debit card plus Affirm capabilities sort of functionally replaces in a point of sale context. So like that is very much their business. And I think, the comparison to Klarna versus a debit card is a reasonable way of thinking about at least some parts of Klarna's business. Jason, just for listeners, I'm going to run through the core metrics, and I pulled these right out of your newsletter since you did all of the hard work. Jump in on any of these that you think are sort of interesting or telling, particularly as they either relate to a firm or maybe that are a little bit deceptive relative to like the actual truth based on that Klarna sort of storytelling angle that you were describing. All right. So gross merchandise volume, which is essentially the amount of transactions that Klarna facilitated, 2024 was $105 billion. Gross revenue was 2.8 billion for 2024. Revenue as a percentage of gross market value, GMV, which you define, and a lot of people talk about as take rate, which is a really, really important metric, is 2.68%. Net income, aka profitability, is 21 million for 2024.
So
go ahead,
and I know this has been I know that this has been widely acknowledged, but that profitability was only driven by the sale of Klarna Checkout.
Yes.
Which my understanding is the sort of strategic decision to sell that is functionally like a payment service provider.
Kind of similar to like a Stripe or an Adyen, yeah.
Yes. Well, and Klarna also partners for distribution with Stripe and Adyen and other PSPs. And so I think the decision was like, we should get rid of this just to like make these relationships work better. And if we time it so that it lifts us to profitability the year before we IPO, like that's, a nice silver lining. The operating income, I believe, was like negative 121 million or something like that.
Yeah. No, that is right. And again, to compare to a firm also is not profitable, right? And so again, to be fair, like this is a business where you're still trying to scale and you're spending a lot of money on sales and marketing. You're spending a lot of money on acquiring these merchant partnerships. For Klarna, a lot of it has been like global expansion into different countries. So that all I think has been very interesting. A couple other ones. Cost of funds as a percentage of revenue. I like that you broke this one down. Was 17.89% for 2024. I'll just flag on that one. Go ahead. Yeah. No.
We were texting about this.
Yes, we were.
Like, I still don't really understand this because, like, one, Klarna does own a bank.
Yes.
And in the IPO filing, it says that like 94% of its activity is like funded from deposits. If you look at Klarna's savings account website, the rate is like less than 3%. Mm-hmm. So I don't understand, or I'm bad at math of why it feels like their cost of funds it is, relative on an absolute basis, 503 million, which is significantly higher than Affirm's for, roughly-ish comparable revenue, and as a percent of revenue is higher. So I believe our friend and bank nerd Kia was mentioning like wholesale funding, but maybe I don't know enough about how that market works in the Eurozone to really like fully grasp what's happening here.
Well, it's funny you flag that one because I noticed that too, and Klarna did talk a lot in their F1 about the advantage they have as being a bank and the advantage sort of trickling through to cost of funds. But you're right. I like that you broke it down in your newsletter as cost of funds as a percentage of revenue, because that percentage is actually higher for Klarna than it is for a firm, which doesn't have any deposits sourced as a bank, right? And it has to go to the markets to get wholesale funding. And I will say that from everything I can tell and everything I've heard, Affirm has done a really good job of bringing down its cost of funds and managing that very well over time. And, in typical fashion, and private credit as a market is kind of booming right now. So maybe that's been a bit of a helpful trend for Affirm. But if you're a sufficiently well-established lender with multiple vintages that you can show your performance on over time and across different economic environments, generally you'll get rewarded with a relatively low cost of funds from those different securitizations, wholesale funding, ABS, all of those kind of things. I still would think my naive position was that even if you're really, really good at working with the market to secure funding as a firm is, you should still have a higher cost of funds than if you're a bank and you're acquiring funds through deposits, particularly as you say, with Klarna in Europe, not paying like a particularly high interest rates, right? And interest rates in Europe are a little bit lower, as I understand it, than they are in the US. And so I would have guessed that before I read your newsletter, that the comparative cost of funds that Klarna would have had an advantage over Affirm, and there doesn't seem to be any indication of that. So, like, Jason, am I stupid? Am I missing something? I don't get it.
If anyone listening can explain this to us, tag us on Twitter or on LinkedIn, because I still don't have a good explanation for this.
Message Jason on
sure
Signal. Jason's on Signal, and just add him to whatever group chats you want, and he'll just
add me to the Capital Markets group chat, the Capital Markets PC small group.
Yes, exactly. And Jason will just lurk in there and get all the answers that we need. So no, that I think makes sense. One last Klarna note, and then we'll move on. 93 million active consumers was the number that was shared in the F1.
I missed this in the newsletter that went out as email. That the definition of that includes people who logged into the app but did not make any transactions.
Yes.
And also, apparently, there was an acquisition Klarna made of something, I think it was called Stowcard, which was like a loyalty card app.
Mm-hmm.
And so somebody I was speaking with said that may just include people who are logging in to use like this loyalty card functionality without using any of the other sort of like capabilities. So it's really in no way is it comparable to how Affirm defines that metric, is the point.
Yes. No, I mean, that top line number destroys Affirm's top line number, but it truly is like comparing apples to, dustpans or something. Like, it's not even like two similar things at all. Looking to grow your fintech with scalable API-enabled payments? Newline by Fifth Third empowers enterprise companies to accept and process payments seamlessly. Effortlessly launch and scale payment, card, and deposit products directly with Fifth Third Bank. Learn more at newline53.com. Do you need more? More time? More revenue? More growth? Software companies are born global, but the complexity of selling worldwide can be overwhelming. Managing payments, sales tax, fraud, refunds, these things slow you down, but getting them right is essential. That's why over 5,000 digital businesses choose Paddle as their merchant of record, or MOR. More. Complete sales tax compliance globally, multi-currency payments, fraud protection, billing support, all taken care of. With Paddle's MOR model, you get more. More time, more revenue, more growth. Learn more at paddle.com.
I want one more metric, and then we can,
move
on. So, like looking purely at the metrics in the F1, and Klarna doesn't refer to this as provisions. I think they refer to it as like consumer credit losses. So, like how they're doing the accounting might be like slightly different. But the losses in 2024 were just shy of 500 million, or about 17.6% of revenue. I don't know if you caught this big campaign Klarna did about a year ago, where the stat they kept emphasizing was that 99% of Klarna plans globally are repaid.
Right.
At the global default rate was less than 1%. And that quote, "This is a testament to Klarna's dedication to offering fair and transparent credit solutions." I don't understand how those two things are true at the same time.
Yeah. Well, so to add on to that, you also have to go back to the reminder fees and snooze fees, particularly the reminder fees growing, right? Like they've grown over the last couple of years. And so again, I have a real hard time reconciling like growth in reminder fees versus 99% paid on time. Like I'm with you. I'm sure there's some way they're sort of finessing the math to make that work, or potentially some of the things they've been saying in the past were a little bit of stretching the truth, but those things don't make a lot of sense to me. I will say, in point of fairness, and I screwed this up in my newsletter, although I've corrected it since, There is evidence of, I think, the story that Klarna generally tells, which is they go into a new market like the US, and at first they take more losses. And then as the argument goes, as their underwriting gets better and as they sort of get to know that market a little bit better, I would say also like they become maybe slightly less aggressive in trying to sort of fulfill all of the wants and needs of the partners that they've gone into over time. But as they sort of mature in that market, their credit losses decrease, and they capture that in a metric called transaction margin in the F1, which is kind of a funky metric, which is why I screwed up my interpretation of it originally, because it's worded kind of strangely in how they describe it. But essentially that measures sort of how efficient they are in generating revenue, taking into account credit losses and servicing costs and some of the other things that tend to be a little higher when they go into a market and then come down over time. So I guess a thing to watch as it relates to that point, Jason, is as they continue to sort of strengthen their foothold in the US and grow in the US, do credit losses, consumer credit losses, come down? We didn't really talk too much about DoorDash and financing burritos. That was another little bit of news that came up kind of around the same time the Walmart thing did. And there is this, I think,
there was a lot of good tweets.
There were some good jokes.
I had a lot of it was funny.
It was a fun 2 days. In fact, I think Sebastian actually got on Twitter to sort of like push back on all the jokes because it was getting to be a little much for him. But you know, on the one hand, like, you know, we already use credit cards to buy fast food. Like, it's not really that different, but there is, I think, this macro sense that people have of Klarna and other pay and for providers sort of driving consumers right to the very edge of what they can afford. And so, again, from a credit risk and credit performance perspective, I think the question is, how does pay and for in particular hold up if there is more of a sort of fundamental shock to consumers' balance sheets or ability to pay? We still haven't really like gone into a recession. So like the credit environment has not really been tested as it relates to pay and for. And so I'm withholding judgment on some of those things until we see how they do in that environment.
For sure. Should we wrap up Klarna? Do we need to make a visit somewhere?
Yeah, we do. Jason, I mean, I don't know, man. Like, don't come to Las Vegas, I think, is kind of the top line for this next story. Because whenever you come to Vegas, the volcano in the middle of the Bass Island Atoll seems to like heat up again. And that happened right when we were all together. This is probably why I didn't see you much apart from the times we were speaking. Can you tell us what the hell's going on?
For sure. I mean, it's interesting, you know, and I think that you've probably detected this theme as well, even though you were unable to come to my panel because you were simultaneously moderating.
That's true. That's true.
In some other room.
I heard through the grapevine, by the way, that you won our little bet about who was going to get more people into the room. I didn't count, but I heard anecdotally. It was early in the morning. It was 8:30. Yeah,
it was 8:30. I don't know what kind of party that Peter at Synctera had. I was in the Treasure Island sleeping at like 8 p.m.
I know that because you ditched out of all of the things very, very early. But anyway, yes, you were doing your whole thing. No.
There seemed to be maybe not a full consensus, but like that, you know, BaaS is now a 4-letter word and people only want to talk about it embedded finance, but embedded finance island does not have the same ring to it.
It really doesn't. We're not going to call it that.
So here's the report live from the ground in Las Vegas. And I have to say, it was like a very interesting, confusing, tumultuous 24 to 48 hours. Yeah. The former chairman, Scott Lenoir, who currently identifies as the founder of Evolv, I did not see him, but I did have multiple sources confirm he was doing the rounds at the Venetian, essentially trying to calm the waters and previewing the unsigned open letter. Though I'm extremely pedantic, and the fact that the letters are just signed like the leadership team drives me insane.
Well, heaven forbid we actually put our name on anything. Yeah,
that's neither here nor there. Yeah. But previewing the open letter that then came out that Wednesday during the week of FinTech Meetup. Simultaneously, a related but separate story, multiple people with knowledge of the matter were telling me that the relationship between Evolv and Mercury had become, quote, toxic. I spoke to enough people that I had a high degree of confidence that this characterization was accurate. So I reached out to Evolv's communication person that Tuesday and got a message back saying, no, this doesn't resonate, and nothing has changed in this relationship. I'm like, okay. I may have been getting a nightcap also at the sad Treasure Island, and at 11:14 p.m. Tweeted Evolv former chairman doing the rounds, Evolv spokesperson says nothing has changed in this relationship. And by the next morning, and I do have a clarification on some of my prior reporting, apparently Mercury informed Evolv some number of hours prior to beginning to email its customers to say, hey, we're moving off Evolv, and made a public statement, to that effect. I will point out that this is not, typically how well-run bank fintech partnerships manage a program transition. Nope. And we can certainly talk about that. A few more small details. According to comments that Mercury gave to an industry trade publication, there were operational issues as Mercury scaled its program with Evolv, particularly international wires, which apparently required a phone call confirmation between Mercury and Evolv to process. On the flip side, an Evolv spokesperson told that industry trade publication that, quote, some of the work entails working with fintech partners to remove certain high-risk end users from their platform, and that some partners did not agree with the new risk assessments and have chosen to seek other partner banks, seemingly a reference to some of Mercury's historic issues with higher risk customer segments, places like certain countries in Africa or regions of Ukraine, etc. The bit about scaling doesn't really make any sense because Mercury, as I understand it, stopped onboarding new accounts at Evolv some time ago, and in fact has been offboarding accounts on an ad hoc process for various reasons.
Because they've been working with Choice and then more recently Column, correct?
Yes, correct. Yeah. It's also worth reiterating that Evolv's consent order requires it to do a liquidity analysis and share that. Yeah. It does not need approval. I mistakenly thought I had to go back and reread it, but has to do a liquidity analysis and share that with its regulator, the St. Louis Federal Reserve, before winding down a fintech program. The implication being that a large, sudden shift of deposits out of the bank could potentially pose a liquidity risk. And it is worth pointing out that as of its last call report, so the end of 2024, 30% of Evolv's deposits are uninsured. In separate and I guess more positive news, just today, Mercury announced that it has raised an incremental $300 million of funding, and I think I saw it was at a $3.5 billion valuation. So good news for them. What do you think regulators think, and I guess in this case that's like the St. Louis Fed and Arkansas State Department of Banking, but I mean FDIC has skin in the game too. What do you think is going through their head when they see this chaos, and I would describe it as chaos, just spilling out publicly, like crazy open letters, like emails where the bank doesn't know what's happening, like social media, like it can't be a positive.
No, I mean, the thing that immediately popped into my head when I saw all this reporting, which is fantastic reporting, by the way, and Jason got a few more gray hairs, I think, as he was doing all of the reporting on this story while he was in Vegas. But I
did. If you saw me Wednesday morning, it was like,
He looked a little. I did see you a couple times in the hallway, and you just had this sort of like set to your shoulders. I was like, oh man, something's going on. The first the first reaction I had to it was picturing Marty Grunberg somewhere going, see, I fucking told you. I told you this is how it was going to go. And it's like,
broker deposits.
I hearken all the way back to the broker deposits thing, right? Where it's like, the point that they were trying to make with the overly broad and unnuanced, essentially rollback of the broker deposits rule that had happened under the Trump administration prior was that these relationships are dangerous, essentially was the kind of core point, right? They are not stable core relationship deposits. And, again, like you were critical of the proposed broker deposit rule. I was critical of it. Our friend Kia Hazlitt was critical of it. Like none of us really liked it. And it didn't really seem to be based on an actual analysis of the data. It didn't really approach the topic with any like nuance. I sort of heard through the grapevine that like Grunberg and the FDIC didn't really care that there was no nuance there or what impact it would have on the fintech ecosystem. Like, they didn't really give a shit about that. But there was this sort of like intuition, I guess, that like this thing is not the same as kind of core deposits, right? And it needs to be classified differently. We need to treat it differently. It's dangerous. And all of the fintech arguments and all of the BaaS bank partner arguments around, oh, no, these deposits are like very safe. They're very like stable, like they're very predictable. We can model how they're going to behave, all these things. That all took a huge hit in relation to all of this, right? And the thing I find really strange about this story is both sides of it, right? So on the Evolv side, I have absolutely no idea how Evolv could possibly be surprised by this. And from everything I can gather, they were surprised by it. It caught them somewhat by surprise. But like to your point, they knew that Mercury was not happy. They knew that Mercury was not onboarding new customers. They knew, because it was announced publicly, that Mercury had added Column as a partner bank, which clearly indicated that they were moving in that direction. So like Evolv being either pretending to be or actually being like, no, everything is totally fine. There's nothing going on here. We don't expect any material changes with Mercury. We certainly don't need to do a liquidity analysis. It's unclear if that actually happened or not. That all is just bizarre to me, right? Like it was patently obvious that Mercury was going to do this from an outside perspective, just looking at like the tea leaves to me. And then on the Mercury side, I also do not fucking understand this at all. Like, how could you tell your partner bank that you were going to be migrating off just reportedly, I guess, hours before you started communicating that to customers? Like, that is a wild thing to do.
They had been planning it, I guess, internally for months.
You have to, right? Like, you're not going to communicate to customers. How do you do that? Like, you're not going to communicate to customers until you've already done all the legwork internally to manage that thing, right? You're not going to tell customers you're doing it until you're ready to do it.
But you can't do that without the bank partner being involved, right?
I wouldn't think.
Really don't. No, and I really don't want to start talking about the Bank Merger Act, particularly because I don't I'm not super familiar with it. Yeah. But from doing the reporting on this piece, legally, those are customers of Evolv.
That's right.
And so if you're, quote unquote, migrating these deposits from Evolv somewhere else to Choice, to Column, that potentially can have Bank Merger Act implications. Similarly, if there are associated debit cards that are issued by Evolv and you're doing a BIN migration, that also potentially can have Bank Merger Act implications. So it's just a wildly complicated process.
It takes like what you reported in your piece, like how many months does it take on average to migrate a program?
Like a typical would be 6 to 12 months. Yeah. And again, like I've never myself done one of these, so this was a combination of talking to people and reading the very excellent guides on Lithic's website.
Right.
But there's all sorts of trailing things you have to deal with, whether that's, chargebacks for things that happened 30 days ago, like ACH reversals or disputes that happen, 60 or 90 days ago or whatever. I mean, I guess these are business accounts, so the protections are a little bit different, but it's an exceedingly complex task, which I think it's fair to say Evolv doesn't have the best and the brightest.
No, I think that is, I mean, I've written about that many times in the past. Yeah, I mean, I think all of that is very true. But again, like, you guys are making Marty Grunberg look right. And like, that should be a badge of shame for everyone involved in this, because like the broker deposit rule got essentially removed. They're not going to move forward with that proposed rule. I think we need something, man, because if this is how these types of relationships can get unwound and the level of chaos associated with them, clearly there are sort of larger risks to the banking ecosystem and ultimately to end customers who, like, I wouldn't be thrilled to know this as a Mercury customer, that like, this is how this transition was planned. Like, it wouldn't create confidence, certainly. We need to have some mechanism to deal with this, because like, this is, again, it's not quite like Synapse bankruptcy level bad, but like, this is one of those little signs of a thing that could have worked out even worse if the conditions had been different, but is like, shows a way that this could go badly, and we need to get ahead of it for whatever's coming next.
For sure. Do we have time to talk charters really fast?
Yes, we'll do it super fast. So Jason in the outline said it's charter time, and then in parentheses said a la Hammer time, unless you're too young to have enjoyed MC Hammer. Jason, unfortunately, I think a lot of our listeners probably do fall into the bucket of being too young. I am not, because I, on many car trips as a child, only had one CD that I listened to over and over again. And one of the songs on that CD was Hammer Time by MC Hammer. And little known fact, I can actually rap all the words to MC Hammer still.
I will
to this
see
day.
you and raise you, because I'm 99% sure I had the cassette tape.
Whoa, dude. We are really a lot older than I like to let on this podcast. That is not good. Okay, so charter time, really fast. Let's not get distracted by MC Hammer, although I certainly could. All right, so 3, we're going to say fintechs in quotes, are have either achieved or are pursuing the acquisition of a charter. So first we have SmartBiz, which acquired a bank holding company, the United Community Bank Shares. This acquisition has been approved by regulators. That approval actually came with a specific and sort of strangely worded press release from the OCC, which was titled Fintech Business Model for a National Bank. And in that press release, Acting Comptroller Rodney Hood basically made it abundantly clear that the window for fintech companies acquiring bank charters through various means is wide open, and we want to see more of this happen. So SmartBiz has successfully acquired a bank charter. Oak North, which is a UK-based small business lender, very similar in a lot of ways to SmartBiz, although they've been operating in the US for a lot less time. They have announced that they are acquiring, pending regulatory approval, Community Unity Bank. Jason, this is getting very confusing with all of these bank names. Shout out our friend Kia Hazlitt, who's like going to die on that hill. And then finally, One Main, which is a non-bank subprime lender that primarily operates in the personal lending and auto lending space. They have filed the paperwork for a Utah-based industrial loan charter, which is a sort of different route to acquiring a bank charter and presumably getting out of the rent-a-bank sort of charter space that they maybe have been operating in. So, Mr. Mikula, we won't spend a lot of time on this, but 2 things jump out to me. One is, as I said, Rodney Hood has made it very clear, like, the window is open, go, go, go. And 2, I think these 3, and again, I'm going to use in air quotes, fintech companies being the first ones through the window is interesting because I don't think, if you think of fintech as like, who are the sexiest, newest, fastest growing startups that are acquiring the most VC dollars, you wouldn't mention SmartBiz. You probably wouldn't mention Oak North. OneMain is, in fact, the sort of fintech amalgamation of non-bank lenders that have existed for more than 100 years. So really not a fintech in the classic sense. So these sort of older, more, I would call them established fintech companies seem to be the ones that are most interested in getting charters. And coincidence or not coincidence, all of them sort of establish their business around doing lending first. What do we think?
No, that's exactly what I was thinking as you were talking. It's like, well, yeah, I mean, the given that the primary business for those three is all lending, like it is logically much more accretive to their business model to have low cost deposits. And then, as you mentioned with OneMain, and I haven't looked at their operating model in a while, but if they're doing quote unquote rent a charter, the benefit of like reducing their regulatory risk by having the Utah ILC. Mm-hmm. I did find it slightly amusing that you just like know that OneMain had that sitting on a shelf, like waiting.
Oh yeah.
to file it, because I mean, it was very clear that in with Democratic control at FDIC that like ILCs were just a non-starter.
Totally.
And that didn't seem, even with Marty's pending departure, which now has happened, it didn't seem likely that would change with different Democratic leadership at FDIC.
Yeah.
Which, I don't know, we don't have time to discuss like that whole weird schism about bank holding company, blah, blah, blah. But I mean, on the one hand, I'm happy to see like progress here.
Yeah.
I hope it's done in a like thoughtful, responsible way.
Yeah.
I will continue to be on my hobby horse of like, I wish this stuff didn't have to swing back and forth so aggressively, administration to administration.
It's weird that like you have to have the paperwork on the shelf ready for the chance that one party's going to win versus another, and then it's like the window's open, go. I mean, it's very strange. It's an odd way to do it.
I mean, the IPO window as well. I mean, that's
right.
Different. That's a market. That's market forces more than regulatory forces. But now it's like, yes, okay, Klarna and Chime and eToro.
Right. No, it's very true. I mean, the other thing that I'll just point out about this is kind of relating to the like old fintech company or unsexy fintech company thing. I do think there is going to be sort of a reverse correlation between the odds of success that a fintech company will have in getting a charter, either de novo or acquiring an existing bank charter, and let's call it the velocity of their business, right? And the reason I say that is just that, even under a Trump administration, prudential regulators are prudent, right? Like they're not crazy. And all of the people who've been nominated to lead the agencies are all pretty like inside the margins, kind of normal bank regulators that first and foremost think about safety and soundness, right? And so they are not going to be, I don't think, like overly aggressive in trying to court the like highest risk, highest velocity, most innovative fintech companies to come get a bank charter. Don't worry, we won't like try to hamper your business. You can move as fast as you normally do. Like to a degree, I think there is a level of incompatibility between fintech startup scaling, speed, shipping velocity, and operating a bank in the way that a Republican or Democratic OCC, FDIC, Fed would want to see, right? Like those two things just don't quite go together. And so if you're someone like a OneMain or SmartBiz or Oak North, you're already kind of acting like a bank, right? Like you're pretty stable. You don't ship all the time. You're not like really that innovative. I'm sorry. Like you still do a great job serving your customers, but you're not on that sort of bleeding edge. The example I think is sort of as a contrast is someone like a Ramp, right? For example, I just don't see Ramp wanting to get a bank charter anytime soon, because I think they're still in that mode of like, we want to move really fast. We don't want to be told no. We don't want to have to check with regulators every time we're going to do something. Like, I think there's a class of fintech companies that we think of as more like the innovative side of fintech. And I just don't know that that business model, which is really like effective for them and profitable for them and is the way they attract more VC funding and get the public markets interested. I don't think that model is really all that compatible with getting a bank charter. And I don't really think that's going to change as much as we might think it would over the next 4 years.
Yeah, I mean, I know this is sort of like a super high level generic way to describe it, but like having been in sort of both worlds, admittedly only for 2 years at Goldman versus longer in the more like fast growth fintech world, it is just like a fundamentally different culture and DNA. Yeah. And not to say that companies like Ramp and Brex and Mercury, et cetera, aren't great companies, but that sort of risk on, risk off, or risk tolerance attitude typically flows from senior leadership, CEO down. And if you've spent the past 5 years as a, move fast and break things like hyperscaler, it's just culturally, especially, don't even get me started about bringing that attitude to lending.
Well, you have to start in lending and get your teeth kicked in before you can really get good at lending. So I will say any fintech companies that don't do lending but want to get a bank charter and then get into lending, I can't tell you enough. Don't do that. Like, get into lending and learn it before you get a bank charter. Don't do it the reverse way, please.
But should we move on to what we can't let go of? If you want to go first.
We need to rant. All right. I'm going to say off the top that for anyone listening, like in the car, maybe you have kids in the car with you, like this is like earmuffs time because I'm going to like lose my mind for like 2 minutes. So just bear with me. I apologize for the profanity that might result. But there is I'm going to call it a neobank for gamblers that has just received $17 million in a seed round. It's called Edge Markets. The product is called Edge Boost. I think it's the worst thing I've ever seen. Maybe, I don't know. I sort of just, I think I had a stroke when I first was like looking at their website. But the thing that's really disturbing about it, and I've written a lot about gambling and sort of the convergence of financial services and gambling, and this is pretty much like sits right in the middle of that intersection. The way they present it, Jason, is as a sort of like vertical SaaS solution almost for professional gamblers, right? So like if you're a professional gambler and you need to have a separate bank account for your business that's different from your personal account, and that business bank account needs to be able to transfer large amounts of money instantly to different books and different casinos, and you don't want banks to put a hold on that because they're concerned you might be losing your mind, we're the bank for you. And I guess if you sort of squint and think about that, like maybe, perhaps that makes sense, right? Like every category of SMB owner deserves a bespoke bank account. I kind of believe that. So like, whatever, that's fine. The problem is that the universe of professional gamblers is very, very small. People who actually do this as a business. It's maybe a couple 100,000 at most in the US. That does not justify a $17 million seed round. But Edge's lead investor, Bullpen Capital, is very familiar with the larger market that they could potentially attack, which is the sort of amateur, just trying out gambling on the side market. That is much, much bigger and has been growing faster over the last, 7 years. And actually, Bullpen Capital invested in FanDuel, which is one of the biggest companies that has benefited from that growth of amateur gambling. And when you look at a lot of the products and features built into this bank account, Jason, they are not features and products that are being built for professional gamblers. They're being built for amateur gamblers. There's a whole responsible gaming component to this app that provides like cooldown periods or this mechanism that you have to get like a friend's authorization in order to gamble more. Guess what? Professional gamblers don't need that. Professional gamblers don't gamble with emotion. They don't gamble from a position of sort of psychology taking over their decisions. They gamble in a very cold, rational way. That's what makes them professional gamblers. If you're a professional gambler, you don't need responsible gaming features. You know who needs that? Amateur gamblers. So I will say I hate this so much. It drives me out of my mind. I think it is horrifically embarrassing that Cross River Bank is the bank behind this fintech company. And let me just say one last thing, which is one of the VCs who invested in this company, after I sort of ranted about this on Twitter, replied saying, "Thanks a lot, Fun Police." And you know what? Fuck you. That's all I have to say. All right, I'm done.
For what it's worth, I also had this same one in the outline, but I knew Alex's rant would be better than my rant, so I let him have it.
I appreciate you.
My somewhat related follow-up, I do have Robinhood on my phone and like a very small amount of money that I like sometimes just like essentially gamble with in an amateur way.
Sure, amateur gambling.
Mostly just to experiment with the app. And when I opened it earlier this week, it told me that it's Gold Month. They're doing a 1,000 gold bar giveaway. If you join Robinhood Gold, I swear that I don't get a commission on this, sadly. If you join Robinhood Gold and make a deposit, you get a chance to win a gold bar. Every eligible dollar, they don't define eligible, deposited it into your brokerage account as an entry to win. So, I mean, whatever, it's a sweepstakes. It just feels like tacky and gross, like most of what Robinhood does. And it's, I guess it's on theme for this month.
I hate it. I mean, I know like a lot of these things get presented as like, oh, if you squint in the right way, this is just another like bank account, or in Robinhood's case.
Oh,
like,
no. Yeah, it's a new asset class.
Or like, this is just private banking reimagined or whatever. No, it is gambling. It is deeply irresponsible. People are going to get hurt. And by the way, all of this has very real world, non-financial consequences, right? Intimate partner violence goes up by a measurable amount when an NFL home team loses in an upset. And that effect is more pronounced in states that have legalized mobile sports betting, right? Like, this shit has like an actual real impact on people's lives. And to see VCs or fintech founders or CEOs like joke about it or have fun with it, it makes me just want to kill someone, Jason, honestly.
The last word, and then we'll cease the downer. This is, I briefly lived in the UK where sports gambling is I think far more prevalent.
Yeah.
At least historically, it's been like far more accessible than it has been in the US, including digitally. And like, I remember sitting at like the sad airport lounge at Gatwick and just seeing these guys like chugging beers and like betting on soccer matches.
Yeah.
And I'm like, oh yeah, this is not good. And then couple that with, again, historically in the UK anyway, access to like, quote, high cost short-term lending. It's like, oh yeah, you're taking loans at the time would be like from Wonga or my old employer, Quick Quid.
Yeah.
And then you're like using that to like go to the pub and gamble. And it's like, yeah, let's just leave it there.
Yeah. We don't like it.
We don't like it.
Thumbs down. All right. Jason, it has been a delight to both cover fintech with you in a sober, sort of just data-driven way, as well as to rant as always. I'm sure I will see you out on the road. Hopefully not too soon. Hopefully you get a little bit of a break, but we will see each other soon. And obviously we'll be back at this next month. But thank you, sir.
Yeah, looking forward to it.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.